Hello, this is Manesh Patel with Ichimoku Trade. Today is May 24th, 2016, and what we want to do is go for a trade review with you guys. And we want to specifically talk about Best Buy and its earnings. We want to talk about pre-earnings and post-earnings. Reason why is a lot of people thought the Ichimoku charts were telling you to go bullish in Best Buy going into earnings, and we want to talk about that. Also, we want to talk about the seasonality. A lot of seasonal software basically talked about how Best Buy statistically is doing really good go in earnings and this and that for the quarter. So we wanted to address all these issues that a lot of people talk about and kind of tell you how you should be thinking in the thought process, and you should be trading probabilities. Okay, seasonal software by itself does not work. Ichimoku by itself does not work. You have to have a good trading plan that consistently is successful from trade to trade to trade. If you want to use both of them, that's fine. We'll show you exactly how you could use that together in conjunction where one verifies the other one. But if you're sitting there just using seasonal software by itself and then looking at a simple Ichimoku chart to sit there and verify, that's not going to work either. So let's begin. Let's go for our normal disclaimer to state this is for education use only. We're not soliciting you to buy or selling a particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group, cannot be copied or distributed without our written permission. We are broker neutral, so we support all the various charting and brokerage platforms out there, from TradeStation, eSignal, Thinkorswim, and so forth. Today we're going to specifically sit there and look at eSignal for looking at Best Buy, along with alert trades for seasonality. Here are my contact details here, so if you have any questions, you could email us or you could give us a call at any of our office locations. So let's go through and let's look at the seasonality. There's a lot of seasonal packages out there. However, what we did was we released a free seasonal package called Alert Trades. This is available for mobile phones and also website. So what I'm going to do is I'm going to log in here. And what we're going to do is we're going to look at Best Buy here, and we're going to look at this in terms of May. And we're going to look at May. Reason why, it's still the end of the month, so we want to look at May, and then we want to also look at next month to kind of analyze what's going on before earnings, at earnings, and after. Now, with this seasonal software, remember this is free. There's no charge at all. This is free, and the reason why we released it free is we used a lot of seasonal software out there, and it becomes biased. And the reason why is most people just look at percentage movements to determine seasonal patterns, but you can't really do that. Reason why is a lot of things vary week, year by year by year, depending on what state the market is, what the volatility is. So what we did was we developed our own seasonal software that looks at volatility on a yearly basis, monthly basis, weekly basis, and so forth. And we crunched numbers, and this is what we get. So initially, right now, we released the seasonal software. It looks at monthly data. In here, you could see for the month of May, this had a 51% chance of being bullish. And if you look at the prediction, all these values are in percentages here. It had an average move of 5.6%. It could make a move, but look at the drawdown, 3.8. So if you look at the reward in here, and you look at the average move here, which is the max or average profit you can make in your drawdown, this is not a 3-to-1 at all. That means you have to look at your technical charts, and you have to make sure you get in at a very good place. Okay. Now, this SIV value at 7.2, what that does is it tells you if this month is a consolidation month or a trending month. Now, since this is below 10, this is typically telling you that this is going to be a consolidation month. So that tells you even with earnings, the probabilities of the earnings sitting there breaking a major support resistance on a daily time frame is less, not high at all. There's a couple of years here that has sat there and started a major trend, which is 2012 and 2010, and then down here in 2007 and 2008. However, that's not happened. Also, if you look at last year, look what happened here. It sat there and was bearish. It went down at the end of the month, basically average a 0.2% movement down, not up. So you could see here there's no real pattern there as far as May is concerned. So a lot of people tell you that statistically it does good for earnings for Best Buy. It really doesn't make sense at all. And remember, earnings varies day to day, to year by year by year. So you have to be very careful how you look at these statistics. If you look in June, this is a 69% chance of being bearish. So a lot of people saying that's going to follow through, and post earnings, it's going to go up. The probability is low. In fact, last year it moved down 6.4% from the beginning of the month to the end of the month in 2015. And you could see it's been alternating after 2011. It's been alternating completely here. And you could see the movement that's going to happen is it going to be a trending month. So in June, Best Buy is going to trend. Okay, you have to rely on your technical charts. Now, let's go to the Ichimoku charts, because a lot of people sat there and said this was bullish going into with the Ichimoku chart. We saw a lot of blogs and everything going into there. So if you look at May here, May 1st was right about here. So May 1st started off right about here, which is right there. Okay. Now, in order for, if you look at the seasonal software, it looks at patterns, right? We're looking at monthly, and you could see from the monthly pattern here, you could see that if basically in order to start a trend, it had to break this resistance here, or it had to sit there and get below the cloud, which is basically break that level there. So you had a range right here going into the month of basically this level here or that level right there that had to be broken in order for it to start a trend. And if you look at it, this was just sitting there consolidating within this in here. So even though this was above the cloud here, if you look at this level here, if you look at the charts, this is just consolidating. So even though this is above the cloud, it doesn't mean you go jumping in and go bullish and think that this is going to go bullish going into earnings at all. And the thing is that you don't see that. The key things is that if you're going to use Ichimoku for earnings, you want to sit there and take the trades at major support resistance levels completely. And if you look here, what happened on the daily time frame, you were here. You weren't at a major support resistance level at all. So it's like you sitting there taking a trade between multiple different zones. If you're taking trades between support resistances, your risk is a lot higher, and that's exactly what happened here. So even though this was bullish here on the daily time frame here, it doesn't mean it was bullish, because it was just trying to sit there and get to the top of the consolidation pattern. And the problem in here is that these consolidation patterns, if you notice, the pivots are going lower, and that's not good at all. Okay. The other thing you have to realize is that there was no earnings at all going into the earnings announcement today. And if you look at it, this thing sat there, held the support here, and bounced off there. This movement here that took place right before earnings was a big percentage movement here. And if you look at that movement here, this percentage movement from the bottom of that cloud to the top, okay? And if you look at that percentage movement, that was an 8.83% movement up from the bottom of the cloud here going into earnings. That means the whole thing is that everyone was thinking that Best Buy was going to go up. So they already started buying 3 days or 4 days beforehand and sitting there jacking this thing going up. This is dangerous. Reason why is that if some stock moves up 8 or 9% before earnings, or even 5% before earnings, your reward is going to be limited to a point it's not even worth the trade at all. Okay, there's more upside, there's more money to be made on it going down than going up. So you have to understand that. If you sat there and took this trade here, what is your upside? If it comes up to here, which is your upside here, at most Best Buy is going to go up another couple of points. Let's look at what the upside is. Let's say you bought here and you took it from here to here. If you looked here and you looked at the upside here, you most had a 2% upside. With options, maybe you got to about a 1-to-1 reward risk ratio, but with the IV dropping and everything, you're not going to get that at all. This did not make sense at all. In fact, this was sitting there being bearish. One of the things that we did was that we actually bought here, and we sat there, we were playing as bullish going into earnings. And what happened is, before earnings, at this day right here, we took our profits. And the reason why is this had a high probability of going down. Had an 8% movement up. That was enough for us to sit there and get to a 3-to-1 reward risk ratio on our options trades. So we took that trade off. And then what we did was we took some of the profits that we had on that trade, and we actually got puts basically 2 months out coming all the way down here because IV was still low in those puts because everyone was thinking this thing was going to go up, and we actually just took profits this morning on the Best Buy right here when it came back to this support right here. So this is a trade that we sat there had more potential downside than upside. That's why we took the profits. We ran with those profits. We took a little of those percentage of those profits and bought some cheap puts and basically got out right here at this low here. Okay, that's the way you should be playing earnings correctly. Okay, now the other thing is that if you're doing earnings, you need to sit there and not look at the daily charts like everyone else is doing. If you're a Ichimoku trader and you're doing earnings, you need to look at the weekly charts. In the weekly charts here, this is below the cloud. If this is below the cloud here, you're basically going to be sitting there playing bearish. Okay, this did not even hit the green line, didn't even hit the bottom of that cloud. This is consolidating here, and it will sit there and have a high probability of still going down because it's below the cloud. And if you look at the monthly time frame here for Best Buy, here, this is the monthly here. You could see it's now in the cloud here. It was above the cloud, but it's below the green line, which means nothing at all. It's not doing good at all. And if you look at the quarterly for Best Buy too, you could see here that this thing is in the cloud here. And if you notice the support here, which has been flat for a very long time, this month is the very first time that support moves. That's no longer a valid support here. That support's from the past. Our support is now moving. That means this support is weak to a point this could sit there and break down lower and go a lot lower. It depends on where we end at the end of the quarter. And if you notice, this had a chance to go bullish. It has not done that at all. And this is actually weakening with time. Quarter by quarter, this thing's weakening down, which is not good at all. So couple of key points to take away from this video is that one, sit there, don't jump to the seasonality and just think that it's always going to be correct. Seasonality depends on the formula that people use, and the problem with a lot of seasonal formulas is that people do not incorporate the volatility that's gone on for the entire year, the week, the month, and so forth. They're just looking at simple percentages, and if you're doing that, it's not going to work at all. Even if you do look at that, verify with technical analysis. If you're using Ichimoku, stick to the weekly time frame for earnings, and you get a better accurate results. And if you sit there and do daily time frame, at least have some common sense to understand that if something runs up at 5% or 10% before earnings, take your profits and run. Reason why is limited upside. And remember, the key to trading is get a high reward risk ratio. The only way you're going to be able to do that is to make sure your entries are close as possible to the boundary conditions, close as possible to major support resistances. That's why you should have bought here, not here the day before earnings. Okay? The closer your entry is to key support resistance levels, the lower your risk, the higher the reward risk ratio. These are the things that we basically teach you in the Options University. So if you do want to sit there and move forward in learning how to trade earnings correctly, you can sit there and contact us and look at our Options University. That's where we teach you how to do pre-earnings, post-earnings correctly using Ichimoku and also seasonality the correct way, and it's safer because we're looking for a 3-to-1 reward risk ratio. Here are our contact details. Have fun and have a good trading day.